Most retail investors believe the safest move for retirement capital is to leave it completely untouched in the state system. But inflation quietly erodes the purchasing power of your ordinary account balance every day it earns only the base rate. If you want to protect your financial future, you need to understand exactly when to deploy these funds and when to leave them locked in place. Today, we look at what the Central Provident Fund Investment Scheme, the $20,000 rule, and the newly closed special account actually mean for your retirement layout. No marketing fluff. Here is what that erosion looks like in real terms. On an ordinary account balance sitting at 2.5% while daily household and corporate costs rise across the island, the gap between what you earn and what you actually need compounds every year you leave it unexamined. This is not a reason to panic and rush into private instruments. It is a reason to understand the mechanics before you decide either way. When we look at the market, we see two very distinct types of market participants. On one side, you have the growth investor who chases momentum and willingly tolerates high volatility using their personal cash reserves. But on our side, we focus on the wealth preserver profile. Our entire approach is built to protect your core retirement nest egg, which is our absolute forensic standard. We do not give room to marketing fluff here, just the cold, hard operational facts. To make sensible decisions, you must understand what the official Central Provident Fund Investment Scheme framework truly represents. Let us be honest, it is not a casino account or a green light from the government to gamble with your retirement nest egg. It functions strictly as a controlled gateway that provides heavily regulated access to approved private instruments. This is a structural trade-off where you gain the potential to beat the guaranteed state floor rates, but only by accepting corporate risk. The architecture of this investment scheme splits your capital into two distinct accounts that carry entirely different operational rules, risk profiles, and retirement purposes. First, you have the CPFIS-OA bucket, which manages your ordinary account savings typically earmarked for housing commitments or short-term family needs. Second, you have the CPFIS-SA bucket, which deals with your special account savings dedicated strictly to long-term retirement funding. The state system offers policy-protected yields that look highly secure in global markets, paying a guaranteed base rate of 2.5% per annum inside the ordinary account and 4.0% per annum inside the special account. However, a static 2.5% return on your ordinary savings can leave your retirement funds falling behind in real terms. When daily household expenses and corporate costs rise across the island, your purchasing power takes the hit. This is where our standard auditing thresholds apply. In my regular audits, I hold an absolute forensic floor of 3.2% as the minimum return required to justify taking any risk with your capital. Because moving into private instruments exposes you to market volatility, I demand a mandatory risk premium of 150 basis points for equity exposure. That establishes our minimum yield hurdle at 4.7%. Since the default ordinary account rate sits at 2.5%, it falls below our forensic floor, meaning the entry barrier to invest these ordinary savings is exceptionally high. We cannot talk about long-term wealth preservation without addressing the structural policy shift executed by the government. In February 2025, the special account was permanently closed for all members aged 55 and above. This single policy adjustment completely altered the retirement wealth playbook and dismantled old strategies overnight. When the closure hit, special account balances for older members were automatically transferred into the newly created retirement account up to the prevailing full retirement sum. However, any excess funds above that retirement sum did not stay in a high-yielding retirement account. Instead, they were funneled directly back into the ordinary account, meaning those surplus funds no longer earn 4.0% and now sit at the lower base rate of 2.5%. Wealthy individuals used to park huge sums of excess cash inside the special account to harvest a guaranteed 4.0% yield with zero market risk. That door is now locked permanently. You cannot rely on passive government guarantees to protect your surplus wealth anymore. The system now forces you to become a disciplined analyst of your own capital, because if you leave your expanded ordinary balance completely untouched, inflation will do the damage. The structural impact of this policy depends entirely on your age bracket. For members aged 55 and older, the special account framework no longer exists, and those funds have been completely repurposed by state policy. If you are under the age of 55, your special account remains active at 4.0%, but your investment options are highly restricted. The framework permits lower risk products only, meaning you are barred completely from purchasing gold or individual corporate equities with those savings. So what does this mean for you? If you are under 55, your special account savings are still compounding at a highly secure 4.0%, which matches our benchmark quality anchor for guaranteed yield. In most cases, leaving that money exactly where it is stands as the most forensic decision you can make. But if you are 55 or older, you are now looking at an expanded ordinary account balance earning a basic 2.5%, which forces you to examine the ordinary account mechanics closely to see if deployment makes mathematical sense. Before you deploy a single dollar from your ordinary account into the private market, you hit a mandatory retained threshold. You must keep a minimum balance of $20,000 inside your ordinary account at all times. This is a non-negotiable safety floor designed by the state to protect your emergency housing commitments. Only the surplus funds sitting above this $20,000 baseline are classified as investable savings. Within CPFIS-OA, you can invest only your investable savings after setting aside the first $20,000 in your OA. Of that investable pool, up to 35% may go into shares, property funds, and corporate bonds, while gold products such as approved gold ETFs are capped separately at 10%. Let us pass these hard regulatory boundaries through the Auntie test using a clean, real-world Heartland example. Take MDM Tan, a 52-year-old resident living in Bidok who holds a total ordinary account balance of $80,000. First, we apply the mandatory baseline, subtracting the $20,000 that must remain completely untouched. This leaves her with an investable savings pool of exactly $60,000. When we apply the 35% cap to that pool, her absolute equity ceiling comes out to $21,000, leaving the remaining $39,000 restricted to lower-risk instruments only. If you attempt to allocate more than your permitted ceiling, your transaction will hit an automatic rejection gate at your agent bank. The mechanical reality retail savers often miscalculate is that these percentages are derived from the investable savings pool, not the total account balance. As we saw with MDM Tan, her $21,000 equity limit is 35% of her $60,000 of investable savings, not 35% of her total $80,000 balance. When you apply a strict forensic lens to state fund selection, you must calculate the immediate opportunity cost. When you deploy cash, your opportunity cost is low, but when you invest ordinary state savings, you are actively giving up a guaranteed risk-free 2.5% per annum. Any private investment you select must clear that lost interest baseline first before it generates a single cent of real retirement profit for your wallet. Many savers fall into a common optical yield illusion. They buy a corporate equity paying a 4.0% dividend yield and assume they are winning. In reality, you are taking on 100% of the corporate business risk, exposure to bankruptcy, distribution cuts, and asset value collapse, all for a thin 1.5% premium over the default state rate. If that business faces structural trouble, your core retirement nest egg takes the direct capital hit. To protect against market volatility, our framework applies a conservative forensic floor of 3.2%, which we hold firm regardless of temporary market dips. We audit for the storm, not just the sunny day. When you add our mandatory risk premium of 150 basis points to that floor, you get our minimum yield hurdle of 4.7%. If a private instrument cannot comfortably clear this hurdle, it fails to justify the risk of moving your state savings. If we run the standard asset classes through our forensic screening framework, we get very clear strategic stances. Singapore Treasury bills fluctuate and remain a strategic neutral. Fixed deposits yielding 2.2 to 2.8% are generally unsuitable because they fail to clear the hurdle. Blue chip equities yielding 3.5 to 5.0% sit on a highly selective watch list. Meanwhile, real estate investment trusts yielding 4.8 to 6.5% achieve a conditional pass, provided they clear our balance sheet gates. When assessing a property trust for ordinary account deployment, you must test the balance sheet against our strict financial gates. First, gearing must sit comfortably below our 35% ceiling. Second, the interest coverage ratio must remain above 4 times, proving operating profits easily cover debt obligations. Finally, the asset must deliver a durable yield above 5.5%. It takes a pass on all 3 gates to earn a conditional deployment nod. If it fails even one, you keep your money locked at the default rate. Many savers get excited when a bank representative shows them a mutual fund yielding 4.5% that can be bought using ordinary savings. They completely forget that fund fees and transaction costs come out of capital immediately. Once you subtract the guaranteed 2.5% interest you gave up, plus management costs, your net return for taking equity risk is dangerously thin. Never give up a guaranteed state return for a private promise that barely skims past the floor. In dividend investing, we often focus on the yield spread, meaning the gap between a stock's dividend yield and the risk-free rate. But there is another drag on returns that might be overlooked by retail investors: transaction friction. If you deploy $10,000 into a Singapore REIT and part of that amount goes to minimum commissions, clearing charges, platform fees, or other trading costs, less capital is actually put to work on day one. That reduces your effective starting yield and raises the break-even return you need before the position begins to justify itself economically. Data is only useful if you have tools that let you act on it without having trading costs quietly erode your returns. That is why I chose to partner with Longbridge for this channel. They currently offer lifetime zero commission circumflex on US, Hong Kong, and Singapore stocks with fees clearly broken out so you can see the actual friction on each trade. For this segment, we have set up an exclusive arrangement specifically for the first 10 viewers. If you open and fund a Longbridge account with at least 10,000 Singapore dollars, Longbridge will provide a direct 100 Singapore dollar asterisk cash credit on top of their existing June welcome rewards, subject to their full terms and conditions. Here is how the full reward bundle works if you deposit $10,000, hold it for 90 days, and complete 5 buy trades. First, you receive the exclusive $100 cash credit tied to this collaboration. Second, you receive 300 Singapore dollars worth of NVIDIA fractional shares. Third, you receive a 5% per annum interest boost coupon, valid for 365 days on deposits up to $4,000, potentially worth up to 200 Singapore dollars over the year, depending on how you use it. Finally, you receive platform fee coupons that can offset up to 450 Singapore dollars of fees across US, Hong Kong, and Singapore markets. All of these rewards are designed to stack, so qualifying viewers do not have to choose between them. Why does this math matter to a forensic investor? Because $100 on a $10,000 deposit is an immediate 1% day one yield boost before you have executed a single trade. Combined with the interest boost coupon hash and platform fee savings, the total welcome package meaningfully neutralizes transaction friction and protects your margin of safety from the moment you fund the account. This is strictly limited to the first 10 spots. The link and full terms are in the description. Other fees and terms and conditions apply, so read those carefully before you proceed. But for a forensic investor who cares about entry cost and yield from day one, this is worth 5 minutes of your time. Now back to the video. To see the direct impact on your wallet, let us examine a specific financial context using the case of Mr. Lee, a 58-year-old retail worker living in an Ang Mo Kio HDB flat. Following the structural closure of the special account, he now holds a balance of $150,000, sitting entirely inside his ordinary account. He is currently within a 7-year transition window before retirement drawdown officially begins. If Mr. Lee chooses a completely passive path and leaves his entire $150,000 untouched, the math is entirely predictable. He secures absolute capital safety and generates exactly $3,750 a year in guaranteed interest. But if he chooses an active path, he can look to deploy a calculated portion into a qualifying Singapore property trust yielding 5.8%, provided it first passes every single one of our balance sheet filters. Let us run the exact numbers for his deployment layout. First, we deduct the mandatory state baseline, leaving him with an investable savings pool of $130,000. Next, we apply the 35% equity rule, allowing him to deploy $45,500 into the trust, which generates an annual distribution of $2,639. The remaining $104,500 stays in his ordinary account, earning 2.5%, adding $2,612.50. Combined, his total annual return rises to $5,251.50, securing an annual wallet uplift of exactly $1,501.50 compared to the passive strategy. However, we must emphasize this is a conditional pass only due to his exact life stage. At age 58, Mr. Lee cannot afford a sudden collapse in capital value. If he accidentally buys a highly leveraged property trust, the setup becomes a structural yield trap that destroys his underlying retirement nest egg. If clear market opportunities yielding above 5.5% are missing, the only logical stance is strategic neutrality, letting the funds compound at the default state rate until a genuine mispricing occurs. Making structural mistakes with your core retirement assets within these complex state frameworks can cost you decades of compounding wealth. If you want to keep your portfolio anchored in hard forensic numbers, you cannot afford to guess your way through these setups based on assumption or media delay. I am Iggy, forensic investor, and your guide through the SGX market jungle. Stay disciplined, stay forensic, and protect your hard-earned capital from common institutional yield traps before the market moves against you. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and educational purposes only. It does not constitute investment advice, financial planning, or a recommendation to buy, sell, or hold any investment products. The author is not a licensed financial advisor. All views expressed are solely those of the author. All investments carry risks, including the potential loss of principal. Past performance is not indicative of future performance. Seek independent professional advice before making financial decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.